Hi, welcome back to the channel. Now, before I walk through all of the key charts and data, as well as walk through a high-level broader market analysis, it's been an incredibly good last couple of weeks since our last video with mega cap technology stocks rebounding very well. Add in the continued rotation that we're seeing into the energy space, everything kind of looks like it's playing out very well at the moment. So hopefully my YouTube work 2 weeks ago helped you in some way. Hopefully my Twitter posts over the last couple of weeks have helped you in some way, despite all the negative news headlines surrounding Michael Burry and his $1.6 billion doomsday bet on a US market collapse. It does look like for the moment it's another one of his market calls. If you don't know Michael Burry, he's correctly predicted 83 of the last three crashes. So, you know, who would have thought he would get it wrong again? But let's not dwell on the past. We have September to look forward to. We do have some seasonal headwinds, and everybody's wondering if there's something just lurking around the corner. No doubt there will be some fireworks here and there, but in this month's analysis, I will get through all of the major indexes to give some clear context on what we're seeing. I have around 15 individual names and areas of the market that I think you can add to your watch lists for the next few weeks. And as always, I hope you find a lot of value from my work, and hopefully the Scottish accent isn't too difficult to understand. Now, the big question I think most people have is around technology and whether the technology correction that we've had recently is as bad as it gets. On one hand, we've still got the perma bears screaming it's 1929 and 2007 all over again, and then on the other hand, we've got a lot of perma bulls just screaming to buy every dip. Now, as everybody knows by now, I'm neither a perma bull or a perma bear. I'm always open to all outcomes. I simply analyse the data as it comes in, but managing risk is always the priority. Now, investor sentiment at the moment is creeping towards showing some greed after recently showing a little bit of fear a couple of weeks ago. So there is a little bit of exuberance coming back into the market. So there is a lot to get into this month. Now, for disclosure, myself or my clients may already hold positions in some of the names mentioned, but I have highlighted those disclosures on the charts. If you're new to my channel, I like to use a combination of technicals and fundamentals. I'm told I'm really good at removing a lot of confirmation bias from my charts. As most of you know, I do not use the magical hindsight indicator. I timestamp all of my work, which is massively important for the field in which I work. I'm not a short-term day trader either, looking for tiny little 20-cent moves. I'm looking for structural trends in the market that will last weeks to months with systematic process and logical targets. Now, my work is pretty much for everyone, everyday investors, traders, options folks, swing traders, financial advisors, money managers. It's not designed for buy and hold investing, unfortunately, unless you are using price charts to scale into some of the names that you like. I'm told my charts are among the very best, so hopefully they make sense. But before I get into it, a couple of quick things. I'm not one of those analysts who makes broad market calls before they play out 6, 12, 24 months later. Like I said before, my work is all fully time-stamped. Very few go on the record with their work. I'm one of them. Just some of our big time-stamped calls over the last couple of years. We got the market crash 1 year ago within 10 days of the crash. We covered every single major turning point in the market last year, including the bear market rally last June, the rally top in August, the market bottom in October, which was obviously massive, the rotation back into technology at the start of the year, and you could go all the way back to the crash of 2020 as well. Now, I only use my own charts and data. As I said before, I do have a track record of being mostly correct, which does help in this field. So if you do find value from my work, please do hit the like button, share, subscribe on YouTube. Also, feel free to follow, share, repost on Twitter also. It's all much appreciated. But please do pause the video. Make sure you're comfortable with that very important disclaimer. Now, if you are somebody that needs technical analysis software, we have recently partnered with TradingView. They provide a very generous free 30-day trial. They're absolutely perfect for everyday investors and traders using technical analysis, as well as being incredibly cost effective. I only partner with the best companies, and TradingView are one of them. But to be clear, this is not for access to our client work. This is purely for technical analysis software, and there is a link in the description for a free 30-day trial. But I think the best thing to do is really just get into these charts. There is a lot to get through here, but let's actually, instead of starting with the S&P 500, I think at the start of every month I like to just take it back to the yield curve, which, as we all know, is currently inverted. Now, the big warning signals with the yield curve are going to come when we start to come out of the inversion and we start to advance towards positivity. I think most of us probably understand that. So at the moment, I'm very much focused on individual areas of the market. When the market does decide to fall off a cliff, which it did threaten to do a few weeks ago, it really just comes down to a weight of the evidence approach and treating each chart on its individual merits. So whilst the yield curve is inverted, and we all know that it's a very good indicator of an oncoming recession, the thesis that I've been working on, and those of you that follow my channel closely already know that I've been working on the assumption that we're already in a recession. I don't know about you, but it feels like a recession. I have friends that are taking on second jobs. It's not an environment that is plain sailing. It's not all sunshine and rainbows out there. It's a very challenging world at the moment. We've already had 2 consecutive quarters of negative GDP. We had that last year. Since then, things have been positive on the GDP front. But as I said, I've been working on the assumption that we're already in a recession. If you have a look at the job numbers, the non-farm payroll numbers, which are being revised constantly at the moment, so we're getting these reports which come out today saying that the job market's fine, but what you'll probably find next month, the month after, is there will be a revision down. That's something that we've been seeing a lot of over the last few months with the non-farm payrolls. So I think there's a lot of shenanigans going on with the economic numbers. I don't think we can trust them. So the only thing that we can trust, and that I trust, is price. And of course, we bring it back to the analysis of the stock market, not the economics of the world. So the S&P 500 has had a very logical and healthy 5% decline from its declines from the February and April 22 levels. Now, we've rebounded from very logical levels. We've had a decline in the percentage of stocks that are trading above their 200-day simple moving average, but we are above 50%. So for the moment, I'm viewing this as a very healthy, very textbook decline in the market. I think the market's healthy. I think the market's okay at the moment. There are some charts I think would lead me down a different path, but at the moment I'm viewing the market as quite a healthy pullback. But what I am always aware of, and I have this conversation with our clients coming to every single September. September seasonally is a very poor month for the S&P 500. Now, this is data that is dating back 70 years. We can see on average the September effect across the market is very, very real. So whilst seasonality data isn't a guarantee that we will decline, I think it would be silly not to at least consider it and help us to manage risk perhaps a little bit closer. Now, over the last couple of weeks, I've really been in the camp of buy the dip. Now, for those of you that follow me on Twitter, a lot of you reach out and ask questions, so hopefully this helps. But the volatility index is continuing to be suppressed. Now, in an environment where the market's declining and we're not getting that rip in volatility, you just have to treat it as a healthy pullback. The big headaches come when we start to get volatility ripping into the 20s, 25 with the VIX. We've just not seen that. We did get a bit of a spike, but we never got above 20 with the VIX. So straight away, that's an environment where you would be looking for opportunities in the market. Now, one of the headaches that I have at the moment, and again, if you followed the channel a while, the US dollar index has a very clear inverse correlation with the S&P 500. Now, I've been banging the drum on this for 2 years now. It was the biggest factor in calling the market bottom in October last year when the US dollar peaked. And the big question I have at the moment is whether or not the US dollar index is going to keep going higher. Now, this is a longer term chart. So if we zoom it into the shorter term chart, we can see that the US dollar index is range bound. Now, if you picked up my analysis at the end of last month, which was, I think it was around 5 or 6 weeks ago I put it out, but I just basically highlighted on my YouTube channel that a failed move in the US dollar index would likely bring a lot of stocks under pressure. That's what we essentially got. We had a correction in tech. It's not been a broad-based correction as the S&P 500 chart shows, but when we look at the bond market, for example, and we look at the 10-year Treasury note yield, what are we dealing with here? Is this a top for the 10-year note? Well, if it is a top and we start to see declines in this chart, then that would be bullish for a lot of growthier areas of the market. It would also be an indication that we're dealing with a potential bottom in the bond market. Whereas at the moment, and our message to our clients over the last couple of weeks has been, look, that this might be a potential rebound level for the bond market, but to have complete confidence that we are dealing with a bottom in the bond market, and TLT is a decent gauge, and it's the vehicle that I personally use to express a bullish position in the bond market. To have complete confidence that the bond market is bottomed, I think we need to reclaim those December, March and July levels, and above $100 would make sense. But at the moment, there's a lot of charts that are flashing different signals, and it probably plays into the theme of rotation rather than complete Armageddon in the market. That's the way that I'm currently viewing things. I'm still looking for stocks for our clients to buy, just for disclosure. We've got the triple Q chart, I think, has reclaimed those February and March 22 levels, but I think there's a lot of misconception with the triple Qs, and a lot of you will probably use the Qs as a gauge for technology, but some of you might be unaware that the triple Qs are only 57% technology and 43% of everything else. To get a view of technology, I think you're probably better to look at things like XLK. Now, since we put in the failed breakout in XLK, which for disclosure was the chart that got our clients defensive in tech, we've rebounded from very, very logical levels. I highlighted these levels 2 weeks ago on our YouTube channel just to say, look, that this is an area where we might get a rebound in technology. Now, since then, we've obviously reclaimed those levels, and hopefully XLK can do exactly what the triple Qs have done and reclaim those very significant price levels. But I also like to look at the equally weighted technology ETF, RSPT. As most of you know, XLK is heavily weighted to the mega caps, Apple, for example, Microsoft. But by equally weighting it, all of the names, it gives us a truer picture of actually what's going on. So again, RSPT, highlighted a couple of weeks ago, has rebounded beautifully from levels, and of course that has been a big risk on signal to buy dips in a lot of the technology names, rather than relying on a lot of the headlines and the Bloombergs, the CNBCs of the world. If you don't know by now, I view all those folks as the clown shows of Wall Street. I can't believe they've lasted as long as they have, offering their views in the market, but that's a different conversation. We've got the NYSE composite, again, looking like we could potentially reclaim those 16,000 levels. The Dow Jones Industrial Average, again, it's holding in there above big levels. So again, it plays into the theme that I'm currently seeing of rotation. The All Country World Index, again, has rebounded from logical levels. There's a very strong correlation with the All Country World Index and the S&P 500. So if the All Country World Index is going to rebound, the hope is that the S&P 500 can move with it, given the correlations. Equally weighting the S&P 500, again, has rebounded from the 100-day simple moving average, which, as we can see, as per the chart, holds some merit. So the hope is, again, after a 7% decline, we can then start to make our way back to testing those all-time high levels. The mid caps, the MDY ETF, again, stalled at logical levels, but hopefully it's gearing up. And if we can reclaim these levels dating back to May 2021, which we can see are significant levels that the market is telling us are significant levels, if there is a breakout in this chart, again, that's in an environment where I think we're getting very risk on, despite all the negativity and the economic conditions, etc. Now, the small caps are a different kind of look at the moment. I think the general consensus is that the chart is a massive mess. There's not any real trend going on. It's very difficult to pinpoint where it's going to go next. But again, being aware of the levels where it tells us that we're in a massively risk-on environment helps a lot. Potentially cup and handle pattern setting up, but to confirm that pattern, it does need to break out above that 200 level. But this is a very useful chart at the moment. Now, let me just quickly walk through this chart. Now, this is what's called a relative rotation graph. And what the relative rotation graph is, if the center point of this chart is benchmarked against the S&P 500, we have four quadrants. We have a weakening quadrant, we have a lagging quadrant, we have an improving quadrant, and we've also got a leading quadrant. And as I'm sure you can guess, the theory behind the rotation graph is all of the sectors go round in circles. Now, it doesn't work like that. You get these little excursions. They go back and forth between different quadrants, especially on the shorter term daily rotation graph. But this is a longer term structural weekly rotation graph, and as you can see, there is a massive rotation into the leading quadrant for a lot of the energy, oil and gas, commodities sectors, whereas we are seeing a rotation out of the technology sectors. Perhaps Triple Q and XLK are just the two ETFs that I've used for a visual here. So a lot of my work over the last couple of weeks has actually, there has been, of course, a lot of buy the dip in technology, but I think for longer term structural trends, you're probably going to find that comes from a lot of the energy markets. Now, you just need to have a look at these two massive charts in the energy space for Brent oil and crude oil. The reason that these are important, if you like to buy stocks, these are going to drive the moves in the energy stocks. So again, it does look like these charts could potentially break out going into Labor Day weekend in the US. So these are two charts that I'm watching very, very closely, and I will be communicating these to our clients this weekend as well. We've got gold. Again, I think there's 50% upside in gold, provided we can get above that $2,100 level. And we've also got the commodities index, which, if there is going to be a broad-based move in commodities, the Bloomberg Commodity Index, I'd like to see above that 110 level. Now, that's really just a broad market analysis and walking through a lot of the key charts that I like to use just to gauge where we're going next. But if you are still here, it tells me that you're getting a lot of value from my work. So please hit the like button, share, subscribe. It all helps to get my work a lot more noticed across social media. It'd be really, really appreciated. But I am about to walk through around 15 individual names and areas of the market that I think you can do some due diligence on. There's quite a few charts that I've been asked for updates on because I did cover them a couple of weeks ago. But I think it makes sense to start with semiconductors. Now, semiconductors a few weeks ago stopped going up exactly where they were supposed to stop going up, right at all-time highs. And of course, we had the big sell-off in NVIDIA on the back of earnings. Now, since then, the dip has been bought up in NVIDIA. And for me, very, very straightforward Fibonacci chart. As the chart can demonstrate, I think that's maybe something to communicate. As I think a lot of analysts or traders, they try to use the same tools for every chart. Maybe it's moving averages or whatever it is, but every single chart is different. I think that's maybe where professionals come in, is we have the time, because we're looking at the markets for 10 hours a day, to figure out what charts are appropriate for, what tools are appropriate for each chart. And for me, this is a Fibonacci chart. I think if we're above $500 in NVIDIA, I know the PE ratio, I know that it's an absurd valuation. You don't need to tell me. You don't need to email me or drop it in the comments. I know, but I'm not going to second guess price. I seen with Tesla a couple of years ago just the absurd things that did. So if this gets above 500, we're working with an upside target of $785. We've also got Tesla. Now, this has been one of our charts by the dip in a couple of weeks ago. It's been working very, very well. We are working with first upside targets here around 300. It is pulling in today. I think the news coming out of China is that Elon is reducing prices in China, which I don't think is entirely unexpected. But I think that the market currently isn't receiving the news too well. It's down 5% currently on the day. But for me, it's just noise. We work with systematic process, so ultimately bullish above 230, and those are the numbers that we're working with. We've had a massive failed breakdown in Apple. Again, I covered this chart a couple of weeks ago. I've been asked for an update. Again, it's moving very, very well. We're working with our upside targets there around 198. Now, MasterCard has put in a massive breakout here. This has been a long time coming. It's been on the radar for me for about 2.5 months. I think over the course of the last week, we have now had that confirmed breakout. So it's very, very straightforward for me. It's bullish above 400, below 400. That bullish thesis probably comes into question. Again, another one of our buy the dip charts, AMD rebounding from very, very logical levels. The hope is that semiconductors can break out, but what I do want to just maybe draw your attention to is on this pullback, we did not reach an oversold condition. RSI is in a bullish regime, so hopefully that lends itself more to a buy the dip candidate, and hopefully it can continue to move higher. But like I said, it's bullish above $100. I think below $100, again, the bullish thesis is probably called into question a little bit. Amazon, patiently waiting. It met our upside targets here 6 weeks ago. Done very, very well, but we're still waiting on that confirmed breakout. I think $145 is probably the level there. We've got TJX. Now, for disclosure, this has actually been a chart that we've been covering for a couple of months now. We are working with an upside target there of $100. If you're not familiar with the term, the $100 roll, it just basically means that once a chart gets to that $90 level, it's almost inevitable that it goes and tests $100. There's not any science behind it. It's more of a market psychology thing. So again, we're expecting TGX to hopefully go and test $100. But again, if it does pull back, we want to see that $88 level hold. Again, Cameco Corp, if you are not familiar with what's going on in uranium at the moment, hopefully the chart shows that despite all the market carnage and tech pulling back, uranium stocks have been on an absolute tear. CCJ has been one of our high conviction ideas. It's been working incredibly well. We're working with an upside target there around $44. CBOE, another one, is just motoring. It broke out to new all-time highs last month. That's a massive 6-year base that it's broken out of. So again, it might be worth doing some due diligence there. Moderna, again, I've covered this chart a couple of times. We made a bottom call on it just based on the oversold condition a couple of weeks ago. It's been working really, really well. But for us, the next level, if it can put in a breakout back up above these levels dating back to June last year and September last year, then I think above $118, then potentially Moderna might take the next leg higher. We've got Mosaic Company. We like it above $43 here. Again, this is one of those names that probably plays into the rotation theme. But there are some technology names, don't get me wrong, that are still very, very interesting. I do still cover technology stocks. There are plenty of them that are doing well, but I think the low-hanging fruit at the moment is probably in a lot of names like Consol Energy, for example. Again, broken out of a big 12-month base. We've been bullish above $80 and it's been working very, very well. Ultimately, we'll see how far it goes. Talking about that $100 roll, we are above 90, so hopefully $100 can come into play. But this has been a big one. Now, I actually covered CLS a couple of months ago, just with the message, look, bullish above $15 now. So many messages and emails on this one. How far do you think it can go, Sam? Honestly, I've no idea. I think that's the beauty of systematic process. It stops you from second guessing every little move in the market. Is it the top? Is it going to crash? Is it overbought? Again, I can't emphasize enough, it just takes away all the guesswork. It takes a lot of the anxiety away. Once you learn to kind of put together a process that will just keep you in a trade, in a position for as long as the trend is continuing, then it just makes for an easier life. CLS, again, it continues to go. Loads of our clients and members are holding this one, and it's the same message to them, just remain bullish above that $21 level. It's obviously been massive since breaking out at $15, but ultimately we'll see how far it wants to go. Another one, Intuit Inc. breaking out a rising 10-week moving average. Again, to our clients, it's been very, very straightforward, bullish above 500, and we've got a target there of around 692. We've also got Verisk Analytics, bullish above 240. We've been covering it a while. Systematic Process has it up at $233. Spotify has been one of our buy the dip charts over the last couple of weeks. Again, it's starting to show relative strength, but it is now one of those charts that is probably looking a little bit frothy at the moment. Just given the run that it's had, it's only had one down day in the last 2 weeks. It has now filled this gap. So for me, and something again I'll be adding to this chart at the weekend for our clients is, look, given that it's a little bit overextended, just manage risk a little bit closer. If it does pull back, you want to see this 50-day simple moving average hold firm. But even if it doesn't, obviously there's profit built in. But if it does decide to take out the next gap level, then I think that brings in logical targets around 180. Another one, Eaton Corporation, just keeps moving. Absolutely monster chart, broke out of a massive base. We're working with upside targets there around 260. And we also have Disney, good old Disney. They've gone all woke on everybody, and they've pulled back massively over the last couple of years. But we are now pulling back to those October and March levels. That's October 2014 and March 2020. So I'm very, very interested to see what happens here. Can Bob Iger turn the company around and make them less woke, start making good movies again? Who knows? But I think for me, just observing the stock price, I'm quite interested to potentially buy it down here. So I want to see either this level hold firm as support at $80 or a potential failed breakdown with a rip higher. If you don't know the old adage, with failed moves, we often get fast moves going in the opposite direction. So Walt Disney Company will be added to my watch lists. Now, I hope you found a lot of value from this analysis. Please do hit the like button, share and subscribe. If you are wondering who I am and what it is I do, please do jump on to our website at honeystocks.com. We provide memberships and access to all of our premium work. That includes all of our weekend analysis, all of our best charts. We also provide access to all of our best investment ideas in real time, all of our high conviction ideas, access to our midweek halftime analysis. We also provide access to a wonderful community of traders, investors, fellow analysts, money managers from all across the world. Provide access to all of my chart books, which is very, very useful if you want to have access in real time to all of our ETFs, commodities, etc., all of our stock updates. We have that provided within our chart books. And also, if you are somebody that's in the process of learning a bit more about technical analysis, you'll also have access to our complete technical analysis program, which helps you to build a systematic process. And I'm told that it's very, very good. But just to quickly show you what our high conviction ideas look like, if we go back to Tesla, has been massive on a couple of occasions this year. Very, very clear instructions on the chart. Meta, again, massive performer since the start of the year. DraftKings, massive recently as well. We've also got JP Morgan, good winner. Amazon, massive winner. Home Depot, decent winner. Apple, big winner. But I'm very, very unique in what I do. I publish on our website all of our high conviction ideas for complete transparency. All of my work is time stamped, as I've said before. So please do jump onto our website and check that out. Do some due diligence. Make sure that the charts that I like to recommend are the types of charts that you like to buy. I don't recommend penny stocks or low float stocks. It's all high quality companies. And I've done this for the last 6 years, and it's so again, like I said, feel free to do all of your due diligence. But I think my work is probably a good fit if you're somebody that has a mid-term approach, or you're looking to get away from day trading. Maybe you've learned that day trading just isn't consistent and it's too stressful. Maybe you're looking to build a process, learn technical analysis. Maybe you're too busy with work, life, family, business. You want to be part of a community. Who knows? Everybody has different needs and wants. But again, please do check out our website. Do all your own due diligence and see if my work is a good fit for you. If it is, there are options on our website for various memberships. So again, I hope you've had a lot of value from my work this weekend. Enjoy the long weekend, and hope to welcome you soon. Thanks.